Let's be honest, real estate finance can feel a little intimidating. It's a whole world of its own, with a bunch of jargon that can trip up anyone. But what if we could break it all down, right here, right now? In this explainer, we're going to follow the journey of a first-time homebuyer. And by the end, you won't just know the key terms for your exam, you'll actually get how it all fits together for your future clients. Ready to do this? Let's jump in.
So what's the big secret? When a lender gets a loan application, what are they actually looking for to give that big approved? It's not just about one number. It's really a whole story, a person's financial biography. And right now, we're going to pull back the curtain and show you exactly how lenders read that story, step by step.
All right, first things first, can the home buyer even get the loan? This is kind of the gatekeeper stage. Lenders basically turn into financial detectives, looking for clues about whether someone can actually handle and repay a huge loan. So let's open up their toolkit and see what they're looking for.
Okay, picture a classic balancing scale. On one side, you pile up everything the applicant owns, that's their assets. On the other side, you put everything they owe, their liabilities. The difference is their net worth. Lenders want to see that the asset side is way heavier. Why? Because that shows there's a financial cushion, a safety net if things get tough.
Next, the lender grabs their magnifying glass and looks into the past. An applicant's credit report is like their financial report card. It tells the lender, hey, is this person someone who pays their bills on time? For a lender, past behavior is the best crystal ball for predicting future reliability.
Now for the big one, affordability. How much house can this buyer actually handle without being stretched too thin? Lenders have this two-part formula they use, and really understanding it is absolutely critical to getting how they make their decisions.
And you're definitely going to want to remember this for your exam. The income ratio is like a close-up photo. It only looks at the new house payment compared to their income. But the debt ratio, that's the wide-angle shot. It includes everything else: car payments, student loans, credit card debt, the whole shebang. So one's a snapshot, the other's the full financial picture.
Okay, next up, the lender basically says, all right, show me the money. This is what we call cash qualification. They need to see that the applicant has the cash ready for the down payment and closing costs. And just as important, they need to know where it came from. No mystery money allowed here. And then, you get the magic words, you're approved. This is the loan commitment. It's the lender's official promise to give you the loan. But, it's not always a simple yes. It could be a firm, straightforward commitment. Or it might be conditional, like, yes, if the appraisal comes in at the right value. There are a few different flavors it can come in.
Don't let this next term freak you out. A loan constant sounds complicated, but it's really just a simple shortcut for lenders. Think of it like this. If you know the cost of one single brick, you can pretty easily figure out the cost of a whole wall, right? Well, the loan constant is just the cost of one single $1,000 piece of the loan. Once lenders have that number, they can quickly calculate the payment for any size loan. It's just a handy little tool for them.
So, our home buyer is approved. Awesome. But the journey's not over yet. Now they've got to navigate the paperwork, the legal maze. But the good news is, there are some really powerful laws that act as the official rules of the road for lending, all designed to protect the consumer. Let's take a look.
First up, we have the big one, the Truth in Lending Act, or TILA, and the rule that puts it into action is called Regulation Z. The goal here is simple, but it's super important: to make sure the borrower knows exactly what they're getting into before they sign anything. It is all about total transparency.
So what does TILA actually do for our homebuyer? Well, it forces lenders to show all their cards. They have to disclose the true all-in cost of the loan. That's the APR. It also gives the borrower a sort of get-out-of-jail-free card, a short window to cancel certain types of loans if they change their mind. Plus, it keeps advertising honest.
So if TILA is about the cost of the loan, RESPA is about the cost of the closing. You can think of it as the no surprise party law. Its whole purpose is to make sure the borrower knows all the closing costs way up front, so they don't get ambushed with a bunch of unexpected fees at the last minute.
And listen up, because this part is definitely going to be on your exam, the RESPA timelines. Just remember the number 3. You have to get a loan estimate within 3 days of applying, and you absolutely must get the final closing disclosure a full 3 days before the closing. These aren't just suggestions, they are the law, and they give the buyer time to review everything.
This one is pretty straightforward, but it is so important. The Equal Credit Opportunity Act, or ECOA. It basically means lenders have to play fair. They cannot, under any circumstances, deny someone a loan because of their race, religion, sex, age, or marital status. It all comes down to their financial qualifications, period.
And one more law to file away for now, the National Flood Insurance Act. It's simple. If the house your client is buying is in a designated flood hazard area, a lender will require them to get flood insurance. This protects the borrower, and it also protects the lender's investment from, a watery disaster.
So let's just put it all together on a timeline. This is the RESPA roadmap. It takes a borrower all the way from the application to the closing table with these really clear, legally required signposts along the way. The whole point? To make sure they show up at closing feeling prepared and confident, not confused and surprised.
Okay, so we've seen how our home buyer gets qualified, and we've walked through the laws that protect them. But what about the interest rate itself? I mean, why is it 6% one day and maybe 5.75% the next? To answer that, we have to zoom out and look at the much bigger picture, the mortgage market.
Honestly, it all comes down to the most basic rule in economics, supply and demand. Think about it. When there's a ton of money available for banks to lend out, the supply is high, so interest rates tend to be lower. But when money is tight and everybody wants to borrow, well, that demand drives the price of borrowing, the interest rate, way up. It really is that simple.
So, where does our home buyer actually go to get their loan? They go to what's called the primary mortgage market. The easiest way to think about it is like the retail store for mortgages. It's the front lines, where lenders and borrowers actually meet face-to-face and make a deal.
And this mortgage store has a whole bunch of different aisles you can shop in. A buyer could get a loan from a huge commercial bank, their local credit union, or even a specialized company that does nothing but mortgages. They're all competing for that home buyer's business, which, of course, is a very good thing for the borrower.
But who's in charge of the overall supply of money? That's the Federal Reserve, or what everyone just calls the Fed. Think of them as the DJ of the entire economy. By using these tools, selling T-bills, changing the reserve requirement, or adjusting the discount rate, they can turn the volume of money in the system up or down. And when they do, it directly impacts the interest rates our home buyer is going to get offered.
So what's the big takeaway from all this? It's that a mortgage isn't just some isolated transaction between one person and their bank. No, it's part of this huge, interconnected financial web. An applicant's personal credit score matters, the consumer protection laws matter, and what the Fed decides to do on any given Tuesday morning. It all matters. It's all part of the same big system.
And there you have it. From net worth all the way up to the Federal Reserve, you now have the key terms to really understand real estate finance. But look, this isn't just about memorizing stuff to pass your exam. This knowledge is your tool to help guide real people through one of the biggest, most stressful, and most exciting decisions of their entire lives. The real question is, how are you going to use it?